Welcome everyone. So we are planning to take on this difficult task today to explore the insurance implications of the COVID-19 catastrophe. There are three of us. The original idea was we might be sitting on stools alongside each other. We want to make this a bit conversational in approach. So we will see how it goes. You'll have to imagine us sitting on those stools. And just to make the point that actually we are going to be talking at a high level here because there are many issues. The event is very, very much still going on. We have not by any means seen the beginning of the end of it, and so we can only talk in generalities. If you have very specific questions on wordings, then you may need to take them outside this particular session and approach Tim Edwards, for example, for a more detailed response. So I want to pass this on now, just to actually, well, first of all, have a look at the agenda here. I mean, we're calling it, so we're looking at the insurance and reinsurance implications, this is some background to the three of us, which you can read at your leisure, maybe after this session is over. And next slide, please. This is our agenda. So we're going to talk about the specific classes which are likely to be most impacted, how we might rank them. We're going to focus on a few lines of business which we think are likely to be most impacted. We're going to talk about the overall market impact, what the bigger picture perspective as to insurance functioning in the economy, insurance functioning through the rest of 2020, and then last of all consider the question as to what is the protection gap in this area and actually how potentially could it be filled. So I'm going to now pass over to Tim to talk us through some perspective on the classes to be impacted. Tim.
Thank you. Good afternoon, good morning, everyone. I mean, the global insurance industry, like all industries, is now grappling with the huge potential impact of COVID-19. And in real time, the situation then is extremely fluid. And so it's then a very early stage that we list out here some, but not all, potential insurance classes, most at the top and least at the bottom, in our view, exposed to the event. And within each class, we call out the major areas of exposure, although this is not exhaustive. And we make this assessment over the shorter term. So looking at liability exposures, for instance, they have the potential to develop significantly over time, and we make no effort to project these ultimate liabilities out. So there are some key themes, and I'm going to mention three of them. Firstly, the non-diversification of exposure. Starting with contingency, this is clearly going to be a hugely impacted class driven by all major sporting and cultural events either being cancelled or postponed. It's not like there's one region in the world where everyone's sort of ticking along nicely and sort of keeping the market and general sort of sanity of everyone going nicely, and then and that's compensating for those who have experienced a loss, as is most common with insurance. But despite the sort of totality of this scenario for that class, UBS analysts exposure between $7 and $8 billion, which doesn't make it such a huge catastrophe when we look back over previous years. And 50% of that, according to UBS, is likely to be reinsured. The extent of the losses, indeed, of that total market, as with other classes, is likely to depend on policy wordings and whether communicable diseases are included as a reason for cancellation or postponement. Another class I would like to highlight is trade credit, for its role in maintaining continuity within our society. Credit insurance responds to the non-payment of goods or services due to the protracted default or insolvency of a company. And while governments are debatably playing a role in providing economic stimuli and support for companies most impacted, credit insurers clearly also play a role here in maintaining balance sheet flexibility and may assist in loss mitigating actions to keep trade going. A third theme centres over the complexity of understanding coverage to pandemic risk, where each class of business has its own nuances of cover and exclusions that may vary between markets, even by client and contract. And for the purposes of reinsurance, our job as reinsurance brokers at Willis Re is to arrange reinsurances that most closely mirror the terms of the original policies written by our clients. And key then to ensuring this for our clients is the clarity over the named perils and minimizing any exclusions, ensuring that when aggregating losses for the purposes of determining an event, for instance, that these operate on the broadest basis possible for our clients' own interests. So that's a sort of overview. If we now skip into some specific lines of business, there's many points I could have mentioned there. I mentioned three themes, but we do want to go into some issues here in respect of property on slide 8. So in terms of property, the coverage question is a key one, and it centres over whether commercial property policies cover non-damage BI extensions. So this is loss of profits, revenue, or increased cost of working, but to where there's been no property damage. And typical extensions then include denial of access, loss of attraction, and customers and suppliers, also known as CBI. And then if covered, how are these losses covered by insurers? So they typically operate with sublimits, and for CBI cover, that's often lower for unnamed suppliers than for named suppliers. There may also be geographic restrictions, and we saw after the Thai floods, for instance, that regions exposed to natural catastrophe perils may have lower limits. Also, there may be notifiable disease exclusions, and many insurers who, in seeking to avoid a repeat of SARS, excluded SARS-related conditions. Others actually went further and applied additional exclusions for the family of viruses to also include the likes of coronavirus. There's also this issue around concurrent perils, and the example here being riots or earthquakes. So even if COVID-19 losses are excluded in that they're not named, in practice, many losses from perils in operation will be hard to split out. Indeed, in several jurisdictions where an uninsured peril is not explicitly excluded and it cannot be separated from an insured cause of loss, the insured may be able to claim. And it's not hard to imagine a situation with a hurricane or an earthquake, for instance, or a riot indeed, that may come in combination with this period of lockdown and make it a very difficult loss to understand. If we go back to slide 9 and look at the situation with respect to reinsurances, the flow of determining whether reinsurances will respond starts with that understanding I've just gone through on the original policy and whether the loss is covered. Then within the treaty of reinsurance, if the class of business specified, whether it is specified in the reinsurance contract, so for instance CBI, is it explicitly called out as being covered? And then does the treaty cover pandemic explicitly, or if not, does it have any infectious disease exclusion? If not, if all of these are ticks against them, then effectively the reinsurance is likely to respond. And we see the reinsurance as responding in different ways. Individual risk excess treaties are designed to respond to fire and explosion. And the exposure to those treaties is we assume lower due to the underlying sublimits and underwriting guidelines. So the potential, we feel, is in proportional or catastrophe treaties, where the loss may be aggregated to an occurrence in the case of non-proportional, with a specific number of hours, say 168 hours, where the insured may aggregate losses to form one occurrence. The question then we're grappling with is when to start the event and when to attribute loss of profits, revenue, or increased cost of working. And if we say that the government decree in certain countries or the order to close business may constitute a start of an event, we may see the increased likelihood of being able to aggregate losses together where that is the case. So of note now is that renewal discussions are ongoing, effectively passing the risk from one period to the next. And cognizant of this, reinsurers, for instance, are now acting to limit their exposure, and we are having to act strongly in favour of our own clients' interests in this regard. In terms of slide 10, the factors that may amplify or de-amplify losses. Sorry, doubling up. We sort of want to call out a couple of things here I haven't already covered. Firstly, damage definition. This may vary by jurisdictions. Obviously, the broader the definition, the greater the recoverable, but you could easily see situations where contamination after a factory closes, for instance, may be a loss that is attributable to a property element of damage. Coverage litigation, though, is the big topic, as we've all seen in the trade press. There's litigation cases and moves by state legislature to cover, or rather to overturn, exclusions. The American Property Casualty Insurance Association, has said, however, that such moves would threaten the solvency of the entire sector. They estimate that capacity of all insurers in the US market to pay losses is roughly $800 billion, and with commercial underwriters who write the non-damage BI elements, a fraction of that. So the potential losses, if exclusions were overturned, are likely to be huge. So someone estimated between 270 and 383 billion a month, so far larger than industry could bear. If you have any questions over these points, please don't hesitate to contact us at Willis Re, myself, Dave Ingram, or your Willis account representative, and we'd be happy to discuss those in further detail. So if we move on now, sort of continuing the sorry, to slide 11, the sort of the theme here within the lines of business we want to zoom into. Dave, if we look now at life insurance, is it the case that there is lower mortality of those of working age, and is that likely to be a key factor in terms of limiting exposure?
Thanks, Tim. Yes, there will be a mortality impact, but to the extent that the insurance coverages are concentrated on working adults, it'll be limited. But that's a little bit complicated to deal with, and in fact, what we're seeing on the aspect of mortality, we all see horrific reports of deaths from COVID-19, but a high percentage of them are coming from people who are of older ages and of already compromised health, both of which are not as prominent a factor for working adults. Life insurers are also faced by a number of additional issues, though, and some of these may well be larger than the actual mortality claim impact. Life insurers have to worry about counterparties. Reinsurers are sometimes one of the largest counterparties. We think that that's not likely to be a huge impact on life insurers directly, but and we'll get to that a little bit later. But life insurers need to be paying attention to all of their counterparties, not just their reinsurers, any other partners they have, vendors, etc. A lot of my clients in the US, for instance, outsource things relating to their computer systems. So they're either outsourcing the computers themselves or outsourcing the software that they're running on the computers, and they're relying on a third party to maintain those capabilities. And so life insurers need to be very diligent with those counterparties to make sure they can continue to operate their business. A tricky issue for life insurers may have to do with reinsurance capacity. And again, we're going to talk about the specifics of the financial impact on reinsurers soon. But the question is, well, what will happen going forward as insurers are looking to place new reinsurance, and as with the rates of reinsurance, and what we're concerned with, or what life insurers could be concerned with, is some life insurers will, because of losses they experience, or because of a change in their attitude, want to decrease their retention, and that may cause a surge in demand for life reinsurance, and it's unclear that the reinsurance sector will want a lot more mortality risk at that time for similar reasons. So that'll be something that we'll have to work out as we go forward. There will be countervailing pressures, as it shows at the very bottom of the slide. There may be a significant impact on sales. So the overall volumes of life insurance being written may decrease, at least temporarily. So we don't know yet how those things are going to play off against each other. But the biggest impact for life insurers comes from the economics and capital markets. It's investment losses. You've all seen what the stock market's doing. In addition, any credit exposures are pushing down the value of any corporate bonds or other instruments with credit risk. Not as much as the stock markets are going down, but perhaps half as much. So it's a double whammy there, as we call it in the States. And other impacts, and we'll touch on this a little bit more in a minute, is that the economy is slowing down drastically. So that will have impacts on the life insurers as well. And then finally, operationally, you have most insurers in most countries are practicing some or all of their employees on a work from home basis, and so hopefully companies were ready for that, and their employees all have the appropriate equipment to do that, and have the appropriate connections to the internet to be able to access that, and so on and so forth. But are there any issues with that? Will companies be able to do the underwriting that they normally do? Are there steps in that process that need in-person interactions that won't be happening in the near future? So all kinds of issues. In addition to this, you see on the liability side on the balance sheet, part of the economic and capital market impact is that interest rates have been falling, and sometimes being pushed down deliberately by central banks, and that tends to affect life insurers more on the liability side than the asset side. The asset values go up with interest rates dropping, usually, but the liabilities usually go up more. And in fact, some life insurers are pressured because they have minimum interest rate guarantees embedded in their products, and so in those cases the liabilities will be affected quite severely. So focusing back on that mortality issue, as I started to say before, the age composition of the block of business that you have is very important. What we've seen, particularly the studies out of China's experience, which is a couple months ahead of the rest of the world in the outbreak, show that mortality up through age 60 perhaps is very low from the COVID-19. At least the experience in China has been. The mortality is slightly higher, in the low 60s, but then by the time you get into the 70s and 80s of age, you're getting quite significant increases to mortality from the exposed population, from the infected population. I'm sorry, and so if that is the case, that you have exposure to those older ages, then you could have quite a significant impact. But if most of your business is with a working population, that's not as likely. The other thing that's complicated with this is that the pandemic, maybe it'll reach everywhere, and it certainly is reaching everywhere to some extent, but some countries, some locations within countries are handling the pandemic better than others. And so your actual geographic concentration in those areas that are having a worse time with the pandemic than others is going to determine your result as well. And if your business is with industries that have greater exposure to the pandemic, in the U.S., we're calling some positions to be essential, and those are people who are still working while most other people are working from home or have been laid off or made redundant. Then if your concentration of business is in those industries that are actually dealing with people, then you may have greater exposure. If they're with industries where there have been greater layoffs, you may have a greater fall off and a cancellation of your business. This pandemic has a lot of interesting and difficult to manage characteristics. The fact is, it seems to be as transmissible as seasonal influenza. It seems to have a 4 or 5 day incubation period where there's never any noticeable characteristics of it, and therefore, but that it is, recent studies have suggested that the maximum transmission of the virus comes right before the symptoms start to develop, and then the fatality, the need for intense and prolonged care in an ICU is another difficult aspect of this. We don't know yet the degree to which insured mortality is going to be lower than the overall population. That issue of the fact that a lot of the mortality is hitting people with compromised health would suggest that the insured mortality will likely be better, but we don't know. So that's an issue as well.
Okay, Dave. So a number of points there then on life insurance that could both amplify or de-amplify the loss. The sort of working age and the different levels of mortality and how that may vary to the overall population and also between countries. There's a number of imponderables that we just don't know at this stage. So Robert, if we can bring you in here onto employers' liability and to sort of start the discussion around liability classes, we clearly see that at this point it's highly uncertain for the liability classes.
Indeed, yeah. I mean, I've just actually gone back initially to think through workers' compensation as to how that might well work out. I mean, one feature of, as Dave has mentioned, we're still finding out some of the medical aspects of cases, and one open question is there long-term damage caused, is there long-term injury caused to someone who's been through an intense case of COVID-19? I mean, we've seen examples of long-term of breathlessness sometime after the patient has effectively recovered, and we don't know whether there is going to be some long-term injury, because that will have an impact on how workers' compensation could proceed. I mean, as a general rule, an illness is not compensable if the employee is at no greater risk than the broader population. So if going to work doesn't put you at any greater risk than the broader population, then it would be hard to make a claim. But clearly there are questions around. There are certain industries or businesses with a raised probability of employee exposure. An example would be air crew on flights to countries or regions where there's a much higher level of incidence than the background average. They could be considered more exposed. I mean, if their work actually requires them to travel to high-risk areas, I mean, clearly these high-risk areas are themselves changing quite rapidly with time. So, traveling to Wuhan would have been considered high-risk area. Perhaps it wouldn't now, but actually traveling to Lombardy in Italy might be so considered. This may all apply before lockdowns went into effect, but employees required to work closely with others at greater risk. So those who have to work alongside others who have been traveling to high-risk areas might themselves be considered of higher risk. I mean, there are a number of secondary factors that may affect workers' compensation. There are undoubtedly going to be delays in any other medical treatment and emergency currently when hospitals are totally focused on responding to COVID-19. I mean, the good news is that it looks as though workers at home seem less likely to suffer accidents than those in their work environment, although there has been a consideration that when they do eventually return to their offices, they may have forgotten their practices and procedures to keep them safe. So that is on the workers' compensation side, and actually an employer's liability workers' compensation statutes do not fully shield an employer if it's possible to argue that their employer's negligence has been a factor in someone contracting COVID-19 during work or through work-related travel, and also in the situation where other members of the family, the disease spreads to them, and that could be the basis of a claim. But I mean, all of these are significantly going to come down to this question as to whether if there's a long-term health impact of suffering a severe case of COVID-19, that will change the nature of what compensation would be appropriate. I just listed down the bottom of this slide what might be considered higher risk work environments. Clearly, we've seen crew on cruise liners have been subject to higher rates of infection. Personnel working in the frontline hospitals are clearly potentially highly exposed. Air crew on journeys to regions and cities where there's a high incidence. Those who are selling tickets in a sort of open situation, checkout staff in stores, employees required to take public transport to work, while other employees work at home. So all of those could potentially be areas where some liability might exist if there is an injury a long-term injury to be compensated in particular. And lastly, we have to constantly check, or the HR departments of companies have to constantly check where are the new hotspots of risk, because they keep changing, and eventually we will come out of the lockdowns that apply in a number of countries at present. And at that point, we're going to be obviously very interested to know where are the hotspots of risk at that location, because they're going to be in different places to where they've been where they've been seen so far. So in terms of litigation and liability of the public, of customers and visitors, I mean, this is a whole other area where we can see members of the plaintiffs' bar are already contemplating the potential for litigation and for liability costs to then become picked up by insurers. But the passengers on cruise liners, especially those that embarked in March when it was sort of clear that the virus was spreading, there may well be litigation there. The hotel guests in hotels who weren't informed about COVID-19 cases, the occupants of nursing homes are sort of all areas where you could see the potential for liability to be litigated. And there may be challenges for lawsuits to succeed around the proof of causation as to, was infection definitely caused as a result of this negligence. And it's really important for businesses that to escape such situations, that they've had clear policies and have demonstrated their action in reducing exposure and risk. And lastly, directors and officers cover here, which typically follows drop in stock market valuation triggering securities class actions. It's obviously the whole market has fallen here. So the question is, has a particular company suffered worse than the average of the market? And is this a function that they weren't taking these risks seriously? There could be allegations of disclosure deficiencies, breaches of fiduciary duty and corporate mismanagement. And it's important that firms have developed and tested their contingency plans. They can show they had business continuity plans in place to deal with all credible catastrophes, major events. And there obviously will be questions about to what degree this particular infection should have been in some way anticipated. So I think I'll now pass back to Tim.
Yeah, thanks very much, Robert. So, we've looked at 3 specific lines of business. We could obviously talk about other ones, but just to emphasize again the message, if you have any specific questions, do contact us and we can address those offline, or any generic summary ones, we can do that at the end of this presentation. As we now look to the broader marketplace, at the economic level, but also the insurance sector, I'm going to invite Dave now to give his thoughts.
Thanks, Tim. So first, let's think about how COVID-19 could have impact the market. What I've got on the screen here is seems to be, yeah.
There we go. Slide 17. Yeah.
Thank you. Sorry about that. And what we've got here is 3 scenarios that are possibilities for the market, and we got these from a publication of Morgan Stanley. These are a month old, so that's like ancient history in terms of this COVID-19. In fact, even ancient prehistory, because you see there the first scenario suggests that this will just be a minor blip. And we'll go back to doing regular stuff by the end of the second quarter. Morgan Stanley, since this time a month ago, has updated their baseline projection, and they think now that a full recession is the expected scenario, and it's just a question of how bad that recession will be. And in fact, if you look at what a lot of other banks are saying, we looked at a dozen of them, and their estimates for the first quarter GDP go as low as a 10% drop in GDP. That's huge. Looking at the second quarter, the range of these 10 banks is anywhere between an 8.5% additional drop in the second quarter to a 30% drop in the second quarter. That's, you're talking depression territory there. So the idea is that the marketplace, the general level of business activity is going to be drastically affected, as much by the actions that are required to be taken in terms of shutting down a lot of business activity. And in addition, if you look at projections that these same banks had of unemployment, looking at this in terms of U.S. unemployment, again, looking at anywhere from 5.5% to 13% unemployment projection. And yesterday or the day before, one of the U.S. central bank offices published a study looking at unemployment possibilities, and again they're saying that the worst case scenario could be as high as 30% unemployment, which again is totally depression levels of activity there. And we think you need to think about a range of possibilities here, because we really don't know. This is new territory for all of us. And I think I alluded earlier to the severity of the pandemic itself. There'll be a range of scenarios you need to think about as well. So one of the other things you're going to have to deal with is questions. Here's four questions that AM Best has put out. The rating agency has put out into the insurance marketplace and is looking for answers to these soon. But you're also going to get questions from your board, from your top management, from your customers, from your employees. So you need to have a script that you're going to work from, so that the stories to all of these audiences are coherent and similar. Another example of questioning is from the regulators. One email I got this morning told me that in Denmark, the supervisor of the insurance sector wants a weekly report, including the results of stress tests on equity and interest rates, and wants to know about life insurance policies with and without guarantees in Denmark. So just another example. But looking at the questions here from AM Best, you see they're asking about impact on operations. They want to know, had you done any stress scenarios on this, and what are you looking at now in terms of what do you think your 2020 financial projections would look like? And then finally, what changes are you making in your plans, in your assumptions, and in your stress testing? So a lot of questions, and none of us really have answers, definitive single answers. So that's why that idea of multiple scenarios is so important. Now, in thinking about how COVID-19 affects the market, alluded earlier to the effect on reinsurers. We've done an extensive study of that. Here's one part of that study. Here we looked at 18 reinsurers, and we plotted on this graph their exposure because of their holdings of equities and credit risk. And we compared that to their shareholders' equity along the horizontal axis, and on the vertical axis, we looked at their rating. And you see that the vast majority of this group is in that upper left quadrant, which is the strongest. They have lower amount of risky assets, and they have higher ratings. A very small number of some of the largest insurers are in that upper right quadrant, who have riskier investment portfolios but still have very high ratings, and another small group has less risky investment portfolios and ratings that are getting towards the lower end for reinsurers. But the good news is that we didn't find anybody in that lower right quadrant of reinsurers with a riskier portfolio and lower ratings. So we think that when we look forward, it looks like reinsurers could suffer a loss Again, this is one of many scenarios, but could suffer a loss of as much as 110 billion pre-tax. We made no effort to try and estimate everybody's tax impact there, which would be again pre-tax a 20% hit on reinsurer capital. That's the bad news. The good news is that the reinsurers all had a cushion that was in excess of 20% there. So we don't necessarily see any reinsurers that should become at least in this group of large international reinsurers, but we don't know about the specific business concentrations of the reinsurers and how those would be impacted. So, but looking at just the investment part. And so with that,
Yeah, thanks very much, Dave. So that's sort of quite stark, isn't it, in terms of looking at the potential market impact. I mean, if we sort of look to wrap this discussion up and move it forward to how we, as an industry, might want to consider a response. Can I ask a question, Robert? I mean, we've obviously talked about this. To what extent do you feel insurance can play a role, and what are the peculiarities of pandemic as a risk that make this such an acute challenge?
Yeah, I mean, I've had conversations with a number of people, especially from the reinsurance sector, over the past few weeks. And as a modeling organization, we have modeled pandemic in the past, and we've raised the whole question of looking at what happens to other lines of business beyond life and health in a pandemic. So, there has not been much appetite to write pandemic-related business in the past, and for quite a good reason, which is that insurance is all about diversifying risk. I mean, the whole reason you transfer risk to some other party is that they can diversify it more effectively than you can. But with pandemic, it's very hard to think, how do you diversify it? It affects, as we've seen, it can affect the whole world. It affects stock markets and the global economy. So you haven't got an investment and insurance diversification. The actions taken by one country, I mean, cannot always be contained from other countries near and far, and so it would be a huge challenge. And clearly, the insurance sector is talking about a pandemic pool at present, but I'm kind of slightly skeptical as to how this would work, because it would need to accumulate. I mean, if we said the cost of COVID-19 is $5 trillion in OECD countries, and it's almost certainly going to be more than that, and if we assume that is a 1% annual probability event, we would need to accumulate $50 billion annual contribution towards raising a $5 trillion fund, and it would need to be invested in something which is uncorrelated with the economic impacts of the pandemic, which is, that's a good speculative activity to try and think what asset class is completely uncorrelated with the economy, other than shorting the equity markets. But I mean, anyway, so I mean, I feel that only a government can accomplish this, as we are seeing. I don't think myself that there is an insurance pooling solution here.
Yeah, clearly a key point. I mean, if we look now for some of the early conclusions, I mean, it is early days, but Robert, do you want to summarize here for us?
Okay, well, I mean, we've covered a number of perspectives on this. I mean, we covered how you would rank these different classes of business, and I think you rank them a bit differently if you're thinking over short-term impacts and long-term impacts, and claims versus the total losses. But this, I think, is a very good perspective. The focus on line of business, I mean, in particular, as Tim had already mentioned, the situation in the US, in particular. In the UK, the government has supported companies that are specifically impacted by the closure to such a degree that actually there is not so much clamoring, I think, for asking that business interruption should be paying out in addition. The government has sort of close that one a bit, but in the US, it's very much an open issue, and we're seeing these bills being drafted or being threatened to be drafted in a number of states, in New Jersey, in Massachusetts, in Ohio. We've seen some litigation started in tribal casinos in Oklahoma, in restaurant chains in New Orleans and California, and they're sort of probing at the idea of trying to get rid of the exclusion clause, which would clearly be absolutely momentous thing to do, to be able to alter a legal contract in that kind of way, for which no revenue or no money has been actually collected. So I mean, this is, I mean, it's not quite clear where this will lead, but it clearly requires some action, some initiative, some leadership from the insurance sector to do something to appease this sense that actually, in this most extraordinary of catastrophes, that insurance is not really providing adequate levels of support. So and then we come to, as we just discussed, the pooling arrangements, and actually whether there's an opportunity there. So I mean, I think for the insurance sector, these are quite difficult times, in particular because at present it may not be participating to the degree that people think should be appropriate. And so I think that a lot of questions will be asked around that. So Tim, I don't know if you want to draw all these threads together and